We've talked about net present value, and that's what we use to make decisions based on. And just a quick review, NPV, it's an estimate of how much value a project is expected to create. And what's it based on? Expected cash flows. A lot of times what we do is we start a project and we know there's lots of possibilities of what could happen. So we take a weighted average of what could happen based on the likelihood of that happening and come out with a best guess. Those are the expectations. That's what we plug into our analysis, and that's what we base our decision on. However, in virtually every situation, if not every situation, there's going to be uncertainty. We don't know what path a project's going to take on. There's uncertainty in the world. We don't know what prices are going to be and weather is going to be and demand is going to be and what's going to happen on the political front and the social front and what developments are going to take place technologically. So there's a lot of uncertainty as to what will actually happen. And in fact, we would expect actual cash flows to often differ from expectations because a lot of times the underlying components are going to differ from expectations because, as I said, there's a lot of uncertainty in the world. There's a lot of different things that can happen. Our expectations are based on consolidating all that information, but when events take place, when kind of the world happens, we only go down one of the possible paths. Therefore, remember, the decision to pursue a project is based on NPV, computed with expected cash flows, based on final estimates. So you look at all the things that could happen, plug it in, get your final estimates, and plug those into expected cash flows, and that's your NPV. It's often called the base case as well. What if analysis, that's looking at what happens with a project when everything does not happen as expected. So expected is kind of the aggregate of all the things that could happen. What happens when specific outcomes take place? What if analysis helps us understand that. And where it's really, really valuable is during the project planning because you can recognize particular outcomes that can be particularly bad or particularly good, such as if this happens, then this project will wind up losing a lot of value. If this happens, the project will wind up gaining a lot of value. So we can reconfigure the project, or B, if we know where we need better estimates, because if things deviate by a little bit, it has a big effect on value, we can spend more time before the project making sure our estimates are as accurate as we can get, or more accurate than maybe some initial estimates. And once the project's getting going, we know where we can spend resources on monitoring. So if it turns out that high costs can devastate a project, we might want to monitor costs on a daily basis. If it turns out that costs really aren't that important, that even the highest possible cost really doesn't have much of an effect, we can monitor costs on a weekly basis. And it helps us know how to allocate resources. So what if analysis is not used to make a final decision, but it can be very important in project analysis. So let's take a look at 4 types of what if analyses. The first of those is sensitivity analysis. And what you do with sensitivity analysis is you say, what would happen if everything comes out as expected, except for a single individual input? And in particular, we look at kind of a best case and a worst case, or an optimistic or a pessimistic outcome. So suppose we're looking at costs. What happens if everything comes out as expected except costs are best case, as low as they can possibly be? Then you compute NPV, or you find the present value of the expected cash flows if you had best case costs, and that tells you if we had best case costs, lowest possible cost, how much value this project would create. Worst case, highest possible costs. What would the expected cash flows be if we had the highest possible cost? We look at the present value of that, and it tells us something. And we can do this for a bunch of different variables. And remember, when you're looking at one particular variable, all the rest are at their expected levels. And where it's valuable is because it helps us identify those individual inputs that can have a large potential effect on value created, and it lets us know where to dedicate resources. So suppose when we look at costs, if costs are as high as they possibly could be or as low as they could possibly be, it doesn't have that much effect. However, then we look at prices, and we see when we're able to charge a high price, our best case price, this project would create a tremendous amount of value. When we are forced to sell it at a lower price, it's devastating to the value of the project. We wind up losing quite a bit of value. Well, that might say, look, we don't need to dedicate resources to cost, but let's put some extra resource into advertising and as a way to try to increase demand so that we can charge higher prices. So it can be beneficial for a company to take advantage of where to allocate resources and how best to structure a project. Scenario analysis. Scenario analysis is a lot like sensitivity, except where sensitivity analysis involves keeping everything as expected except for one variable. Scenario analysis is keeping everything as expected except a combination of multiple inputs. And so basically what happens to the value created by a project if a set of inputs vary. And typically we might look at how inputs vary in an intuitive way. So for example, if there's a recession, we would expect us to sell less items, only be able to charge a lower price, but costs would go down. Recession could affect our cost of capital. So we look at what happens with all of those and then run through, figure out the expected cash flows if all those things happen, or what the cash flows would be if all those things happen, then discount those and say this is how much value would be created if a recession takes place. Inflation. We'd expect high prices, high costs. If we're planning on selling our asset at the end, we might expect to get a particularly high price for it. Run that through the analysis, keeping all of the unaffected variables at their expected levels, and it can tell us which scenarios are ones we need to pay attention to and which ones we don't. Sometimes we look at a best case or a worst case scenario to give us the range. If everything comes out as good as possible, what's the most value that could be created? If everything comes out as poorly as possible, low price, high cost, that's the worst we could do. So it gives us a range. I think that the intuitive ones are often more valuable because, like I said, they can highlight the scenarios that can have a big effect. So suppose we look at a recession and see, you know what, doesn't make that much of a difference. If we go into a recession, it might affect our price, it might affect our cost, but when we run it through, the value created by this is not particularly bad, and so we don't need to worry about a recession. But suppose we're looking at, let's say, a particular candidate wins an election, or a particular party takes over control of, the legislature. And then we say, well, if that happens, this is going to affect the price we can charge, the number of units we can sell, and we realize, wow, that's a real problem. That's going to, if that happens, this project is a real bust. Then we can either reconfigure the project to not be so sensitive to that, or donate money to the candidate of the party that's more consistent with what's going to be beneficial for our firm. So it allows companies either to make good choices, either to reconfigure a project or use resources to try to maximize the likelihood of bad scenarios not happening. Simulation analysis, sometimes it's called Monte Carlo simulation. So here what we're doing is we're conducting a large number of simulated outcomes. And the reason for that is to come up with a probability distribution for the amount of value created by a project. So what we do is we model the project, and there's a random element to it. So you might say revenue is related to, this function plus kind of a roll of the die. And costs, this function and a roll of the die. And so then you roll the dice and see what revenues are going to be, roll it to see what costs are going to be, and that tells you what's going to happen in year one. Year two, you say, well, based on what happened in year one and based on a roll of the die, this is what's going to happen in year two. And you go through that, figure out what the cash flows would be if those things happened, use that to discount that by the cost of capital, and say this is how much value would be created if that happened. And you put it on a graph, and you do it again and again and again and again and again, and thousands of times to get a probability distribution. And so it's useful for answering questions like, what's the likelihood of the project creating positive value? What's the likelihood that events in the world are going to unfold such that this project creates value? Or what's the likelihood that events in the world are going to take place and such that more than $1 million in value is destroyed, such that the present value of cash flows, given, what's the likelihood that the present value of the actual cash flows that are going to occur is less than negative $1 million. And so that's what simulation analysis is very useful for. Finally, break-even analysis. There's lots and lots of ways of doing break-even analysis, but where it comes into play is what's the level of a given input such that either profitability, cash flows, or value creation is zero. Everything else is at the expected level except for this one input. What's the level we need to get to break even? And what's nice about break-even analysis is it allows us to take things that have financial basis and convert them into measures that are useful for managers. So, for example, we can figure out the fewest units that can be sold during a year, such that the project would neither create or destroy value. And so instead of kind of having it in kind of a finance terminology, if we realize, okay, we need to sell, 780,000, units, then our managers, who may not be finance people but are familiar with the business, say, we think we can sell 780,000, or that's going to be a pretty tough thing for us to achieve, or, based on our experience, there's about a 80% chance of us doing that. And so it helps as a way to leverage some financial analysis with managerial expertise in a way that can come up with kind of a consistent view of things. Important point. Suppose you do what if analysis, and it tells you that value would be destroyed if, under this or under that. It also tells you that value destruction would be highly likely. And what that means is that if we go ahead and pursue this project, we don't know what's going to happen, but likely, whatever will unfold, it's likely, highly likely, that it'll be such that the present value of the actual cash flows will be negative. However, the base case NPV, based on final estimates and expectations, is positive, then we should pursue the project. We're focused on the base case NPV based on final estimates and expectations. Doesn't matter what the what if says, we're making our decision is on the base case NPV. Flip side's true. Suppose we do a bunch of what if analysis and everything looks fantastic. If this takes place, that would be great, value would be created. If this takes place, value would be created. If these things take place in conjunction, in a particular scenario, it would be great. The likelihood of things turning out great is really high. But the base case NPV, based on final estimates and expectations, is negative. Reject the project. Do not pursue it. So what's an example of a project like this? We may have a project where the vast majority of times it turns out great or it turns out good, but when it turns out bad, which happens very infrequently, it turns out really, really, really devastatingly bad. Putting it all together, don't do this project. Likewise, project like this, the what if analysis says probably going to turn out bad, probably not going to be a good project. However, when it does turn out good, it is super duper duper fantastic. And an example that I give is, suppose you had a project that you invested $1 and there was a 99% chance that you get that you get nothing back, so you'd lose your dollar. but there's a 1% chance you'd get $1 million back. Most likely you're losing your dollar. However, when you actually look at the net present value of that kind of proposition, it's positive. I mean, there's a 1 in 100 chance of getting $1 million from $1. So that's the kind of project we're talking about up here.